Good afternoon, everyone, and thank you for dialing in today and joining us for our webinar. Today, we'll be discussing the recently announced thin capitalisation changes. Today, you'll have two presenters talking to you, myself, Daniel Burt, and a fellow tax partner, Denise Honey. A bit about myself. So I'm in the tax advisory team here at Pitcher Partners, predominantly doing work around income tax and corporate tax matters, and have a lot of clients who will be impacted by the proposed thin cap changes, whether that be clients in the property and construction industry or significant global entities who are likely to also be impacted by these changes. Before we get stuck into the session, the current thin cap rules, which have been around since 2001, have been fairly well understood. We've had an asset-based regime during this time. However, in October last year, the Labor government flagged in its mini budget that the current rules would be amended to be moved away from an asset-based regime to an earnings-based regime. The government introduced exposure draft legislation earlier this year in March, and stakeholders were invited to submit comments. Now, following those comments in June this year, the government introduced amended legislation. And we'll get to the detail in today's session, but the bill that's been introduced contains significant amendments to Australia's thin cap regime. It's likely to have material implications for taxpayers. In particular, participants in capital intensive industries, such as property infrastructure, but as well as industries that have a significant time lag between expenditure and a generation of taxable income. Furthermore, the proposed rules are likely to impose some significant issues for certain structures, in particular non-consolidated groups. If the rules do receive royal assent, they'll take effect from 1 July, which is 4 weeks ago. Whilst the government has listened to some of the feedback that was put forth following the March announcements, there are a number of practical issues with the current legislation, which in our view, we don't think have been addressed. In fact, some of the proposed changes will have a material impact on certain funding structures, which could result in a complete denial of debt deductions in some situations. Furthermore, there were some surprising new announcements in the current legislation, which were not expected, which we'll talk to as well. So this slide provides a bit of a useful summary of the new key aspects of the proposed regime. As I mentioned, that the current regime is asset-based, or balance sheet-based, but the proposed regime is going to be looking at the earnings of the relevant entity. The exception to this is for financial entities that are going to continue to be subject to the asset-based approach. However, we won't be focusing on financial entities in today's session. The current concepts of inward and outward entities are both going to be replaced with a general class investor concept, so that does simplify the rules a little bit. But the three key tests are outlined there on the slide. The first main one, which is the default test, is the fixed ratio test. And this will apply unless an election has been made or an entity is deemed to have made an election. Broadly, the test is relatively simple at a high level, that your debt deductions are allowed up to 30% of tax EBITDA. And we'll talk about that concept in a bit more detail shortly. Importantly, the new rules will apply to net debt deductions rather than gross debt deductions. And that can be helpful for certain entities that might be borrowing and on lending, not actually having any net debt deductions. Importantly, under the fixed ratio test, or the FRT, any denied deductions can be carried forward for up to 15 years. Whilst that's a good feature, that may not be helpful for some structures, particularly those clients in the property industry who might be setting up particular joint venture structures that have a single purpose and may only own a single item of land, that any carry forward debt deductions may not be able to be used unless the entity was to be reused for a different purpose. An alternative test is the group ratio test. And this might be suitable for multinational groups who on a global basis have a higher proportion of interest expense to EBITDA. It is optional and also applies on a net debt deduction basis. Importantly, if clients do elect into the group ratio test, any carry forward FRT deductions would be lost. And so this is important to understand. The final test, which Denise will get to a bit later, is the third-party debt test. In contrast to the other two tests, this applies to gross debt deductions. And similarly, there's no carry forward or of denied deductions. This also applies for the group ratio test. One other thing to note is that the term debt deduction, which has been understood for a number of years, is likely to be expanded with the current definition including amounts that are economically equivalent to interest deductions. The explanatory memorandum is pretty clear that this is going to apply to payments like interest rate swaps or payments under an interest rate swap, but it could also apply to a number of other items that currently aren't subject to the thin cap rules. One example that might now be caught would be payments for the general interest charge, the ATO general interest charge and shortfall interest charge, which currently are excluded from debt deduction, but because of these changes, may actually be brought into the thin capitalisation rules. It would seem a bit of a nonsensical outcome for a client who is subject to an ATO adjustment and having a bill for the general interest charge to then be brought into the thin cap regime because their debt deductions exceed $2 million, only to have a proportion of those GIC deductions disallowed. So what has stayed the same from the March exposure draft to the current bill? Don't want to focus too much on this, but the slide sort of shows that the 1 July start date is still anticipated. Given we're now almost at the end of July, that can create some potential issues where existing arrangements need to be restructured because, importantly, there's no grandfathering or transitional rules. The current exceptions to the thin cap rules have been maintained, so hopefully everyone's familiar with these around the 2 million de minimis test. That's still going to apply on a gross basis in terms of working out whether the thin cap rules apply. So notwithstanding the FRT test will apply to net debt deductions, in assessing whether the thin cap rules apply, you'll be looking at gross debt deductions of $2 million. What's also stayed the same is that in addition to considering the FRT and GRT, you also need to consider Australia's transfer pricing rules. And just because an entity is below the FRT or GRT limit does not automatically mean that all debt deductions will be allowed. You still need to consider the application of Australia's transfer pricing rules. Now, what has changed from the March draft legislation? One of the key changes in relation to the definition and the calculation of tax EBITDA. We mentioned that for the FRT, that you can claim interest deductions up to 30% of tax EBITDA. There are now some significant fundamental changes here where types of income such as dividends, franking credits, and trust distributions and partnership distributions, where the borrowing entity has at least a 10% interest in that trust or partnership, are specifically excluded from the calculation of tax EBITDA. And so that can have significant implications where you've got upstream gearing, because it can result, as we'll show shortly, there can be in some situations a complete full denial of debt deductions in those structures. In a positive news, in terms of the changes, there's been an expansion to the capital allowance deductions that can be added back in your tax EBITDA calculation, which is a favourable outcome. Also, another favourable outcome is that for companies that have got a disallowed amount under the FRT, in addition to being able to rely on having to substantiate the continuity of ownership test to use those deductions going forward, they will have recourse to the business continuity test as an alternative test to utilise any denied FRT deductions. The trust loss rules now will apply to trust, whereas in the previous version of the legislation, there were no rules there for trust to utilise denied FRT amounts. There's been some significant changes to the third-party debt test, in particular, which entities are mutually sort of brought in to the third-party debt test, where a borrower elects to use that test. Whilst Denise will talk about this in a bit more detail, the current proposal is that where a borrower elects to apply the third-party debt test, members of the obligor or obligor group, as you might pronounce that word, are brought in. But Denise will talk to that in a bit more detail later on. Furthermore, in what's positive news, entities that have elected to use the GRT or the third-party debt test can now apply to the ATO to revoke that election, which is important because if a taxpayer's elected and made a mistake in their election, thinking they were going to get a better outcome under an alternative test, there is the ability to apply to the ATO to revoke that election. Now, there's also a change is that Section 2590, which was going to be repealed, has now been retained. If Section 2590 was a character from the Godfather movies, I think it'd be Michael Corleone. I won't do the impersonation, but every time Section 2590 thinks it's out, it gets pulled back in. This is the second time in 10 years that the government's tried to repeal 2590, and both times it's been unsuccessful. We'll wait and see what happens with Section 2590 because the government has said it'll be subject to a separate process, but the government has backed away for now on repealing that section. As a trade-off, however, the government has surprisingly introduced new debt creation rules as a separate integrity rule, which was not expected when they announced the June legislation. Not only was it unexpected, we think it has some material unexpected sort of consequences where it applies. But again, Denise will talk to this particular provision shortly. So now we're going to talk about the fixed ratio test, the FRT, and working out how to apply that. And we'll also talk through some practical consequences of some changes. Firstly, to calculate tax EBITDA, you start with the entity's taxable income or loss as per its tax return. So that's a relatively simple starting point. It also means that any income that's not included in taxable income, such as non-assessable, not exempt income, is not included in that calculation. Once you've got your taxable income, add your net debt deductions, so debt deductions less interest income. Add in your tax depreciation, including capital works and other capital depreciation items other than items that are subject to sort of temporary full expensing or 100% write-offs. And then subtract from that items that we just mentioned earlier, franking credits, dividend income, and certain trust distributions and partnership distributions. Once you've calculated the tax EBITDA, now debt deductions are allowed up to 30% of that amount. I guess some important things to note here is that because taxable income is the starting point, if a trust is looking to apply the thin cap FRT test and it makes a capital gain, only 50% of the capital gain is included in this taxable income because of the application of the 50% discount. So whilst this may not impact property clients who are holding property on revenue account, it could make a material impact to trusts that are holding property for a long term and then sell it for a capital gain. We also note that entities that have utilising significant carry forward tax losses in an income year are likely to have a very low tax EBITDA because there are no adjustments for the utilisation of losses. So what this practically means is that prior year tax losses will be utilised in priority to any denied deductions under the FRT test. And given those denied deductions have a 15-year cap, whereas normal losses do not have a time limit for expiry, that could potentially create issues there if the 15-year expires before all those denied deductions are able to be utilised. Now we've got a relatively straightforward example here, just to demonstrate how the FRT will work in practice. We've got $100,000 of operating income, some interest expenses and a small amount of interest income, and that's relevant to determining the net debt deductions. So you'll see that our taxable income starting point is the $30,000 in year one, and to calculate our tax EBITDA, we adjust for the net debt deductions, which increases that to $100,000. Applying a 30% rate to the $100,000 gets us our FRT limit of $30,000, but our net debt deductions in year one are $70,000. So we're actually exceeding our allowed limit by $40,000. So that means that of those $70,000 of net debt deductions, $40,000 of those are disallowed or denied and carried forward to a later year. And so practically that's increasing the taxable income from $30,000 up to $70,000. Now, in the subsequent year, in year two, we've just assumed that there are no debt deductions, and that could be for a variety of reasons. But if there's no debt deductions and our tax EBITDA is equal to our taxable income of $100,000. Our fixed ratio limit for that year is similarly the 30% multiplied by tax EBITDA, which gets us a limit of $30,000 for that year. Now, as there are no net debt deductions in year two, it means that that entity is able to utilise some of the disallowed amounts from a previous year. And whilst there's $40,000 of disallowed FRT amounts, in year two, $30,000 of those will be allowed as a deduction in that year, which leaves a further $10,000 available for a subsequent year. Now, the next couple of slides are going to talk to some grouping issues, and importantly around the changes in the definition of tax EBITDA and the exclusion of distributions from trusts and partnerships. This can really have a material impact on groups that may not be consolidated, but also on entities that might not be able to be consolidated because they're in a holding trust structure and have upstream gearing. And what I mean by upstream gearing is, borrowings at a level above where the actual underlying asset is held. And that's what this example here is demonstrating, that assume we have a two-tiered trust structure, so a holding trust that holds 100% of the units and a property trust that owns the underlying asset. Now, it's not uncommon for there to be upstream gearing in structures such as this. The holding trust might own units in a number of different property trusts and therefore might be able to access better funding rates if the borrowing is at the holding trust level secured against the underlying assets of the various property trusts that it wholly owns. And so what the current changes mean is that if the holding trust has borrowed debt and has net debt deductions, but its only distribution, its only source of income is going to be from a distribution from the property trust, its tax EBITDA is going to be nil because it's going to receive a distribution of $2,000 from the property trust, but because that type of income is specifically excluded from calculating tax EBITDA, the holding trust will have a tax EBITDA of zero, and multiplying 30% of zero still gets you zero. So in that situation, all of the holding trust debt deductions are disallowed. Now, what's also relevant here is that as part of the amendments to the existing rules that we're all familiar with, is that there's no ability to utilise any excess borrowing capacity of any associate entities. Under the current rules, we have an associate entity excess amount where entities can essentially borrow surplus borrowing capacity in doing their thin cap calculations. Those rules have been abolished, and the combination of abolishing the excess capacity of associates and excluding distributions from trusts and partnerships in the calculation of tax EBITDA results in a situation where the holding trust will have zero tax EBITDA and not able to utilise the property trust's excess capacity. Because you can see when you're applying the FRT to the property trust, based on the numbers in this example, it's got tax EBITDA of $10,000. It'll therefore have an FRT limit equal to 30% of that, which gets you $3,000. But it's only got $2,000 of net interest deductions. So the property trust has $1,000 of excess capacity, which is the same as the interest deductions claimed at the holding trust level. But the way that the thin cap rules have been drafted, especially with that definition of tax EBITDA, the holding trust is not able to rely on the excess capacity in the property trust, resulting in all of its debt deductions disallowed. So this is a material issue for structures like this, where you've got a series of non-consolidated entities where there is upstream gearing. Now, there can be some ways to alleviate this, which we will get to in the next two slides. So under this first alternative scenario here, this considers the situation where all of the debt is at the property trust level, rather than having a combination of debt at the holding trust and the property trust level. So in that situation, whilst the holding trust's tax EBITDA is still nil, because it's got no debt deductions, that has no practical consequences for the holding trust. The property trust then applies the FRT to itself. And because it's got $3,000 of net interest deductions and an FRT limit of $3,000, the interest is fully deductible in that situation. Another alternative under the proposed rules to alleviate that outcome would be for the holding trust to borrow money as per the original example, but rather than taking that debt and capitalising the subsidiary by way of a subscription for units, the holding trust could then on-lend that borrowing to the property trust at interest so that its net debt deductions are nil. So it's got $1,000 of interest income matched by $1,000 of interest deductions. So its net its net debt deductions are zero, which then again mitigates the issue because the property trust then applies the FRT at its level because its $3,000 of interest deductions equal its FRT limit. The interest is fully deductible both to the property trust and the holding trust. Now, whilst these two examples sort of demonstrate how some existing arrangements can be refinanced to alleviate some adverse outcomes under the ThinCap rules, one of the keys are that if these rules do receive royal assent in their current form, they're to go live from 1 July this year, which was 4 weeks ago. So clients have essentially, there's going to be at least a month and probably a few more months to be able to restructure existing arrangements, by which case some of the damage may have already been done because the provisions have already been enforced if they do receive royal assent from 1 January. Now, it's not all bad news, I should say. There are a number of situations where the proposed rules are going to get a more favourable outcome than the current rules. This slide is showing one such example where we have a lender who is predominantly funded by interest-bearing debt and uses that debt to on-lend not to related parties, but lend to unassociated entities. So we have lender co lending to borrower 1 and borrower 2, who are not associates or connected with the lender. Under the current rules, because the lender is funded 80% by interest-bearing debt and 20% by share capital, it would have some of its interest deductions disallowed because of the 60% safe harbour debt amount rules that currently apply. Under the proposed rules, though, because lender co is assessed on a net debt deduction basis, this can result in a more favourable outcome for lender co. So as those slides there say, under the current rules, you could have 250,000 of debt deductions disallowed to the lender. Under the current rules, under the proposed rules, under the fixed ratio test, because there are net debt deductions of nil, there's no practical impact from a ThinCap perspective on the lender. So that's one situation where the proposed rules provide a better outcome. Similarly, another example, whether it's for startups or businesses that are just growing, because the proposed rules apply the 30% to tax EBITDA, the faster a business grows, the faster any disallowed amounts can be utilised. And so that can be compared to the current rules where there is no ability to carry forward denied amounts. Under the current rules, once an amount is disallowed, it's disallowed permanently. But under the current rules, those amounts can be carried forward for up to 15 years. So where you've got a business that's grows significantly from year 1 to year 2, as the numbers on this slide suggest, you might have debt deductions disallowed in the first year, but they are able to be recouped in full in the second year, because as you can see, revenue has gone from $1 million to $3 million. So there are some situations where you might get a better ThinCap outcome than the current rules. That being said, as I mentioned earlier, there are some significant issues with the current drafting of some of the definitions. Now, I'll quickly go through the group ratio test, which is the alternative to the fixed, one of the alternatives to the fixed ratio test. Some of the key items which was already alluded to is that it looks at the excess of net debt deductions on a group perspective. So one of the key items, or one of the requirements, is that the group in question has audited consolidated financial statements. So this test won't apply where you've got when you're considering the ThinCap rules to property joint ventures, where you might have an entity that's 50-50 owned or just doesn't actually consolidate with the parent because it's equity accounted. So this test is unlikely to apply for those entities, but for multinational groups who have a single set of audited consolidated financials, a lot of our significant global entities that might have subsidiaries here in Australia, this test is likely to be available. Unlike the FRT, any denied amounts are not able to be carried forward. So essentially, it's you need to be very careful when looking to elect into this rule, because if amounts are disallowed, then there's no ability to carry those forward. The ratio formula here sort of shows how the amount is calculated, and whilst it does seem relatively simple at first blush, there are a number of adjustments that need to be made to the calculation of interest expense and group EBITDA, which means it's not as straightforward as just picking a number from a set of audited financials. One of the key adjustments, as it says at the bottom of the slide there, is that in working out the group EBITDA, any entities that have a negative EBITDA need to be removed from that calculation. And so you'd essentially need to go line by line, looking at each entity in the consolidated financials to work out which entities have positive EBITDA and which ones have negative EBITDA, and remove those entities that have a negative EBITDA. And given that the denominator in that formula is group EBITDA, by removing entities with a negative earnings, that's going to increase your group EBITDA and therefore reduce that group ratio. So appropriate due diligence would need to be made before electing into this group ratio test to make sure you've got absolute certainty on what that ratio is, because once you do those adjustments for stripping out entities with a negative EBITDA, you may find that the group ratio ends up with a number less than 30%. And if you're less than 30%, well, you may as well stick with the FRT test. We have an example here just to demonstrate the application of the rules. It's just applying the formula that we had on the previous slide. So you can see here, based on the facts here of Ozco and Ozco's worldwide group, you can end up getting a group ratio greater than 30%. So in this example, it's 40%. So it would enable the group to have a greater proportion of debt deductions allowed in that income year with that extra 10%. But as I said before, whilst the application of this test might seem relatively straightforward, there are a significant number of adjustments that mean a fair bit of time and effort will need to go into working out what that group ratio actually is. Now, that's the last slide for the group ratio test. So I might now pass over to the third-party debt test, which Denise is going to discuss. Thanks, Denise.
Thanks very much, Dan. So as foreshadowed, our third test is a third-party debt test. It's intended to be a replacement for the arm's length debt test, but it really works quite differently, even though it is meant to be that replacement. It's a little bit like the group ratio test. If you elect into the third-party debt test, you can't carry forward any disallowed deductions. So as Dan mentioned with the group ratio test, it is very important to think about whether you might be able to claim something in the future or not. And it only allows debt, or at least in principle, what it's meant to be achieving is to allow groups to claim debt deductions in relation to third-party debt only, but not related party debt. Now, in principle, that seems, I think, quite attractive for groups that are primarily funded by bank debt or third-party debt. But there are a lot of requirements that need to be satisfied. And in practice, I think we see many, many challenges with the current drafting in terms of satisfying those tests. So what are some of the requirements? So let's say you have, so we have a taxpayer who has borrowed some money from a bank and would like to claim the debt deductions in their tax return. So what's the process that they would need to go through? So first of all, those debt deductions will be limited to their third-party earnings limit, which is effectively the deductions for the year incurred in relation to the third party debt. So that's fairly straightforward, I think. But in order to qualify to actually get the deduction, the debt must be issued and held by a non-associated entity. Now, again, if you're just borrowing from a third-party bank, then that, again, is fairly simple. But the associate rule is, for this purpose, is done or is considered on a 20% plus control basis. And so we can imagine scenarios where what might look like a third party at first blush might technically be an associated entity under these rules. So that's something that will need to be looked at carefully when you are borrowing from persons that, you know, perhaps not just completely third-party banks. The second requirement, which I think is going to lock a lot of people out of these rules, is that the lender can only have recourse to the entity's Australian assets, and those assets can't be rights in relation to a guarantee or a security unless the borrowing relates to the creation or development of real property in Australia. So there's a little bit left there for property developers, really only in that creation development stage, not the ongoing holding stage, unfortunately. But if you don't come within that very narrow exception, you know, in practice, the fact that the lender can only have recourse to, you know, Australian assets is a problem initially, because, of course, you know, many taxpayers, particularly in a multinational group, may well have foreign assets, so that's something to be concerned with. But I think more importantly, there can't be recourse to other assets in the groups. And I think all of us who have dealt with borrowing money from banks in particular understand that typically every man and his dog has to sign up to provide guarantees and securities to borrow money from a bank. And so I think, you know, in practice that restriction is going to be very challenging. The third notable requirement is that substantially all of the funds from the third party lender must be used to fund Australian investments or operations. Now, again, in practice, one might say, well, of course I'm using those funds from my Australian operations, but as with everything, tax is very much about substantiation. And I think that there'll certainly be some challenges from a tracing perspective. And I think those who might wish to rely on this test would need to have processes in place to track exactly where the money has gone, so that it can be substantiated that, you know, the money hasn't inadvertently gone offshore somewhere or to fund overseas activities. And last but certainly not least, taxpayers can only claim deductions under this test where they are Australian tax residents. Now, often we talk about partnerships and trusts being Australian tax resident, and that's probably just sort of a shorthand way of putting a situation where they need to lodge Australian tax returns and do reporting in Australia and things like that. But technically, when you look at the definition of Australian tax resident in the legislation, it actually only covers companies and individuals, or certain deemed companies. And so for partnerships and trusts, they will not be able to satisfy this test as currently drafted. Now, we're hoping that that's a drafting error that will be fixed, but as currently drafted, a trust would not be able to avail itself of this test. So let's look at a short example, and really a very simple example. So let's say we have BCO. BCO has borrowed some money from an associate, ACO, and has borrowed some money from the bank. It has $500,000 of interest expenses in relation to its bank loan, and $200,000 from its associated party. And its tax EBITDA, as calculated under the FRT test, is $1 million. So under the FRT test, the taxpayer would be able to claim $300,000 of losses, being 30% of the $1 million, and the other $400,000 of the total $700,000 of debt deductions that they would otherwise have would be disallowed, but would be able to be carried forward under the FRT test. Now, under the third party debt test, assuming that you could satisfy all of the requirements, which, as I mentioned earlier, is probably a really big call, but assuming that you could pass all of those requirements, then in this scenario, the taxpayer would get be able to claim $500,000 of debt deduction. So that's $200,000 more than they're getting with FRT. However, the other $200,000 would be permanently disallowed. So I think this example illustrates that you might be able to get a better result, but if you think you might be able to claim back in future years, for example, we see a lot of taxpayers where funding expenses and EBITDA goes up and down a lot from year to year. And if you have that volatility, you might be better to bet on being able to claim under the FRT in future years. But if not, then you can sort of take your additional amount in the current year, but you'll have to wear the fact that you'll lose the extra $200,000. The other, I think it's a little bit of a sleeper issue, under the third-party debt test is deemed elections. So if we think about that earlier example where, let's say that the taxpayer chooses the third-party debt test, having weighed up all the options, it makes the most sense, an election is made. Then in that scenario, any of their associate entities that are within their obliger group that are required to lodge tax returns or any entities that have entered into a cross-staple arrangement with that taxpayer will also be deemed to have made a third-party debt test election. And so that, of course, makes the obliger group definition quite important. So the obliger group in this scenario would be the taxpayer being the borrower here, and any entity to which the bank in that example can claim recourse against their assets. So, for example, another entity in the group provides a guarantee and security, guarantee or security, they would be within the obliger group. And so when you're thinking about making that third-party debt test election, you need to think about not only the entity that you're sort of focused upon, but are you actually going to kind of suck in other entities from the broader group into that test? And if so, what would the outcome be for them? And so then in making that assessment, you need to sort of make a decision on a group basis as to whether it makes the most sense. And so that, I think, makes it a bit more complicated, and I think is another reason that people will be quite cautious in using this test. So I suppose just to illustrate that with an example, we can see here that we have, and I think really a very standard structure. So we have parent co that owns A co and B co. A co borrows some money from the bank. Parent co provides a guarantee for A co's loan, and B co provides some security over its assets for the loan. I think a very, very standard arrangement. So let's say that A co decides to make an election under the third-party debt test, but it actually fails the requirements and therefore will not be able to claim any deductions under the third-party debt test. And that will actually mean that it won't be getting any debt deductions, and none of them will be able to be carried forward either. But in doing that, it means that parent co and B co will also be deemed to have made a third-party debt test election, and they'll live and die by whether they satisfy the rules, and if so, how much. And so that's something that we have to be very, very aware of. So, I mean, the earlier slides, I think, very much illustrate the scenario whereby, one, in order to get within, to be able to claim a debt deduction under the third-party debt test, it's important to borrow directly from the third-party lender and satisfy all sorts of requirements, including not having other people, guaranteeing and providing security for the loan, unless you fall within that very narrow property developer exception. But there is one other scenario where groups can have one entity that borrows funds from a third-party lender on loan within the group and have all of the entity in a position where they can claim debt deductions pursuant to the third-party debt test. So I think the example up on the slide there is really I think illustrates the point. So effectively, in order to get within these conduit financer arrangements, you need a conduit financer, so a group treasury entity, for example, that borrows money from a third-party lender, and in most respects satisfies all the standard requirements for the third-party debt test to apply that we talked about in the earlier slides. So the bank can have recourse to the Australian assets of the conduit financer, so in this case, the group treasury entity, but also, importantly, members of the conduit financer's obliger group. So the obliger group being the entities that are providing security, guaranteeing the loans and things like that. So that ability to have recourse is slightly broader than in a standard position for the third-party debt test. But, and there always seems to be a but with this test, it's very narrow, is that the loans to the borrowers, so in this case, we've got the group treasury company loaning money to borrower 1 and borrower 2 up on the slide there. First of all, the loans to the borrowers must be financed only from the proceeds of the external debt. And so again, I think there's very much there's a tracing exercise and a process exercise to be able to keep track. So when that $2 million comes in, I think what would often happen in practice is the $2 million comes in, it sloshes around in the group treasury entity for a while. Money goes in and out to various group entities. It's maybe used to pay some expenses, but it's not tracked as part of a separate account. It just goes into the group funds. I think what you would need to do here to satisfy that first requirement about being financed only from the proceeds of external debt is that you would need to keep track, probably quarantine that $2 million that comes in to make sure it's very clear that the $2 million comes in, and then say that the $1 million then goes out to each of those borrowers and that works cleanly. And then the second requirement is that the loan from the conduit financing entity to other groups in the obliger group will need to be on the same terms as the external debt. So in this case, the same terms as the loan from the bank. Now, there are some minor exceptions to that around sort of very bank-specific provisions on, paying of fees and things like that. But, with some very narrow exceptions, you need to really match the terms and conditions. Interestingly enough, one of the requirements to get within the third-party debt test is that monies aren't used to create associate entity debt. If the group treasury company is making arm's length loans to related, to associates, then that is in fact associate entity debt. So there seems to be some sort of a drafting issue there where actually by satisfying the requirement, you take yourself out of being able to qualify under the rules. We hope that that's just a drafting error that they will fix because it's clearly not within the spirit of the rules. But as you can see, there are some real challenges with applying the conduit financer arrangements. But I think for many groups where there's one borrowing entity and then on loaning, this is probably something that anyone wanting to look at the third-party debt test would have to consider closely. So of course the focus often with within cap rules is just going through and looking at, well, what am I testing? When can I get my debt deductions? And we've, and Dan and I have gone through the 3 different tests. What's now being brought in as part of the bill is an additional anti-avoidance rule that kind of comes over the top of all the other tests and says, well, yes, you might be able to, under one of the other 3 tests, you've got through all of that to be able to claim your debt deductions, but there's actually this sort of catch-all rule that if you get caught out under this new debt creation rule, then you won't be able to claim that debt deduction in any event. And that's a permanent loss of the deduction. So basically any entity that is within the scope, so entities that are within the scope of the thin cap rules will fall into these debt creation rules, putting aside banks and other things like that. And the only way out is if the group satisfies the $2 million de minimis annual deductions test. So anyone else is still going to be in. So what do the debt creation rules actually look like? So at a really high level, we have debt deductions being disallowed in relation to any borrowings used to acquire an asset or an obligation from an associate, or borrowings from associates to fund payments or distributions to associates. So pretty broad. So if we look at the asset acquisition rule, I mean, this slide just goes through in a little bit more detail, like the various steps. Probably the big takeaway here is that it applies to borrowings that are obtained from any entity, whether it be related parties or third parties. So if there's any debt deductions associated with, sort of an asset restructure, within a group, then it's all over. So to give you a couple of examples of, we think reasonably common scenarios that would be caught by this rule, is we have one partner buys out. So on the left, we have partner one buys out partner two. So partners in a partnerships will be associates of each other. Partner one borrows money from a bank in order to pay out the other partner. Debt deductions in relation to that purchase will be denied permanently. On the right-hand side, we have a situation where a unit holder subscribes for units in a unit trust and borrows money from the bank, or subscribes for additional units in the unit trust, borrows money from the bank to do so. Because as a unit holder, they'll be associated with the unit trust, so they're all associates, and therefore, even though, again, it's third-party debt funding, the debt deductions in relation to that borrowing will be permanently disallowed. So the other side of that is also the payments and distributions rule. And so I think this one is, at least the asset acquisition rule is, I think, very broad and quite harsh, but probably reasonably easy to determine if you have that issue. I think this payments and distributions rule practically is going to be very, very hard, as you've got money sloshing all around a group, to sort of identify, which money is used for what. But effectively, we'll have, in this case, debt deductions are going to be disallowed where they're incurred in relation to funding payments or distributions to an associate. And so, that's very, very broad. The only thing that I suppose is of assistance here is that the borrowings need to be obtained from related parties. So at least if the borrowings are obtained from a third party, you won't have the same issue. So I think that's probably best illustrated by an example. I must say, I really struggle to kind of get my head around exactly how this works. So I really need the examples to kind of help me. So in the example on the left-hand side there, we see a group financier entity loans some money to Ozco. Ozco has a services agreement with ServiceCo. It has to pay management fee to ServiceCo, and it uses the funds from the group financier to pay that management fee across. Now, the debt deductions in relation to that borrowing will be permanently disallowed, and I think that would be a very easy thing to do. I mean, these rules are meant to, are stated as trying to apply to situations where debt deductions are kind of being moved into Australia, but there's actually no cross-border element to this. So, for example, there's no requirement that the management fee be paid to, say, a service entity offshore. That could all be domestic in that scenario. And so on the right-hand side, we have borrowings used to fund a return of capital. So again, we've got our unit holder, unit trust example. And so, the unit trust borrows to return some capital to its unit holder. It borrows from a related party. And in that scenario, any debt deductions in relation to that will also be permanently disallowed. If it's in scope of, again, I'm supposed to recap, all of this is assuming that it's in the scope of the ThinCap rules and is over that $2 million de minimis threshold. So So I think we can all acknowledge, I think, that there are some real problems with what's intended with these ThinCap rules. I think there are also a number of areas where the drafting doesn't really seem consistent with the purpose. And so even if one was to agree with the purpose, and I'm not sure we do, then there are some updates that really need to be made. So we are in the process of lodging a Senate submission. In fact, I think that might be happening as we speak. I think it's just getting some final proofing. And there are a number of items that we'll be picking up in that, as part of our, always trying to advocate for, our clients in the middle market. And so probably some of the key things that we'll be putting in our submission is that the 2 million debt deduction de minimis really needs to be increased. And that was put in place in 2014. Interest rates have gone up since then, and costs have gone up since then, and businesses are growing, and the 2 million is really not an appropriate level. Also, we think this is perhaps just as, if not more important, is to amend that $2 million test to a net deduction basis. Currently, if you have kind of back-to-back loans going through the group and like a series of debt deductions, but really only one underlying loan, then you actually have to add all of that up to get to your 2 million. And so because you sort of multiply out really the same effect, it's really not consistent with the overall impact on Australia's revenue. So we really feel that should be amended to a net deduction basis. Dan was talking earlier about the associate entity excess rule under the old provisions. And we really feel that there should be some availability of an excess. It shouldn't just be around, otherwise people are just going to game the system by trying to match the EBITDA with the deductions, and that just doesn't seem like a good policy outcome. Certainly, we think there are a number of refinements that should be made to the third party deduction test, because I think, as I illustrated earlier, that has a number of problems, and at the very least we should be extending access to trusts and partnerships, and we really feel that the debt creation rules need to be significantly narrowed in order to properly target cross-border profit shifting. So whether that's through a purpose test, or that there needs to be a cross-border element to the transfer or the payment, and also some carve-outs for very ordinary transactions, i.e. purchase of trading stock or service fees or things like that. And I suppose next steps. As Dan mentioned earlier, we have a 1 July 2023 start date, which is already in the rearview vision mirror. We have the bills currently at the Senate, and they're not reporting until the end of August, and so there might be some time until we actually really know what the rules are going to be. But certainly, given that the rules have already started, I think it's really important that groups are modelling their outcomes for the FY24 year, which we're already in, and thinking about which method you might need to use, and what reporting mechanisms and tracking mechanisms you'll need to do to have in place in order to make that stick, given that tracing is a big part of a number of the tests. And also review the structuring of any existing financing arrangements, both related party and with banks. It may be that, again, if the rules stay the way they're currently drafted, that there'll have to be discussion with banks and other third-party lenders in particular about where security and guarantees are required, and if there's some way of streamlining that a little to come within the rules. And certainly we'll be monitoring any changes to legislation, but as mentioned, they probably won't come through for some time yet. And so I think in the interim, we need to work with what we have. We've gone right up to the time, and we're very conscious of everyone's time. So thanks again. Dan and I are certainly happy to take questions offline subsequent to this. Please reach out to us or other people at Pitcher Partners if you've got questions on these, and anyone who wanted to submit any questions that we haven't had a chance to get to, we can respond to that offline as well. But thanks again for joining us through the the wonderful world of thin capitalisation on this sunny day.